to everyone who's dialing in to the increasingly exciting Fenix story. This webinar is to cover obviously our recent June quarterly report, as well as recent news flow, which included publishing the Beebyn-W11 Feasibility Study and our decision to restart mining at Shine. But focusing on the quarterly, it was another record quarter for operations. We shipped through Geraldton Port just under 1 million tonnes, so achieving internally targeted run rate of 4 million tonnes per annum, which is a great achievement, effectively representing roughly 1.5 million tonnes of our own material and 2.5 million tonnes of third-party material under our logistics contracts with Coofee Limited and Gold Valley Limited. 400,000 tonnes from Iron Ridge continues the very high-grade 64% lump and 63% fines products. That generated an Australian dollar margin of $65 per tonne based on our C1 cash costs, which was only slightly higher. We said maintained at $79.70. And the team are doing a great job to keep that C1 FOB Geraldton cash cost below 80 Australian dollars a tonne. Operationally, the Iron Ridge mine continues to perform very consistently. We've got a lot of stockpiled material at site. Our Newhaul road logistics business and our Newhaul port logistics business are doing a great job to keep that consistent mine production flowing through into very efficient road transport and port services transport. You see that in the C1 cash costs I've described, but also in our ability to do 7 ships during the quarter and achieve that record run rate. The Beebyn Feasibility Study is a fantastic achievement for Fenix. It relates to the game-changing transaction we secured in partnership with Sinosteel Midwest Corporation. That was a right to mine 10 million tonnes from their 20 million tonne Beebyn-W11 deposit. And so based on the feasibility study, we've now added a 10 million tonne reserve to our mineable inventories at Fenix. And we are looking forward to achieving all of the required approvals to commence mining in early 2025. The financial dynamics of that project look very similar to Iron Ridge. We're targeting a production rate of 1.5 million tonnes per annum, and similarly to Iron Ridge, targeting a C1 cash cost which is below 80 Australian dollars FOB Geraldton. That's going to drive a significant increase in revenues and profitability for Fenix. And that comes on the back of our decision to restart mining at Shine. Shine, as you will know, is the iron ore mine that we acquired as part of the Midwest iron ore assets of Mount Gibson a little over a year ago. We've done an infill drilling campaign, looked at that project very closely, and we're going to commission that as a 1.2 million tonne per annum project, producing 100,000 tonnes a month over the stage 1 mine life of a little over 2 years. Capital allocations, roughly $7.5 million for the Shine project and $25 million in capital for Beebyn-W11. Given a healthy cash balance, we can fund those 2 new mine developments off our balance sheet. And it outlines a very exciting pathway over the next 6 months to go from a 1.4 to 1.5 million tonne per annum miner in the Midwest to a 4 million tonne per annum miner. And that's a significant uptick in scale that we are confident is going to drive a re-rating of the company. So very exciting times at Fenix. And Danica, I know we've got a lot of questions today. We haven't done any exploration at Iron Ridge since we started mining, and we're now completing the first exploration project at Iron Ridge since we started mining. So we've completed some RC drilling. We haven't got the assay results yet, and we have a diamond rig on site at the moment doing some geotechnical drilling as well as some exploration drilling, and that's focused on down dip extensions of the existing resource, as well as 3 new target areas on a tenement package where we think there could be some either extensions and or lookalike mineralisation. And that's obviously very exciting given that Iron Ridge we're currently mining the highest grade hematite ore body on mainland Australia. So any more of that type of mineralisation we can find and convert into mineable inventory is going to be very exciting, and it's particularly important given that we're now more than halfway through the ore body at Iron Ridge. We're closing in on our 5 million tonne milestone, and we have a 10 million tonne resource there. Extensions are limited given our respect for heritage, and we mine in a very sensitive area in partnership under our native title agreement with the Wurundjeri people. So we're being very careful about our exploration program, and we'll wait and see what those results are, and then obviously discuss any potential to extend the mine life with our native title partners and the local and the group. However, I do think there's an opportunity for us to add to the inventory, but we'll just have to wait and see. Obviously, if we can get another year or two out of Iron Ridge, that'll be fantastic. But also, as you know, we're turning our mind to additional exploration opportunities as well as acquisition opportunities in the Weld Range. And on that mine life extension, it's worth noting that although obviously our feasibility is based on the 10 million tonnes that we have a right to mine off Sino, the ore body and in fact the mine plan is based on the fact that that deposit is 20 million tonnes, and we're obviously working on a broader and longer term agreement with Sino Steel over the many other projects they have in and around us in the Weld Range. So in summary, lots of opportunities. We will be publishing any interesting results we get from the exploration drilling at Iron Ridge, and we're working very hard on extending our inventories in the region. It's a very good question. We've always seen a very strong similarity between the opportunity to build a mine at Iron Ridge, which is what Fenix did from inception, and the opportunity to do the same thing at Beebyn-W11. The couple of differences, obviously, the in situ grade of Iron Ridge was close to 65%, and the in situ grades at Beebyn-W11 are 62%. So it's slightly lower grade, but still a very, very high grade, high quality resource. Beebyn-W11 has a couple of advantages that offset that grade differential, and that is the strip ratio where it is lower, and it's also in a less sensitive area culturally. So we will not be as constrained as we have been at Iron Ridge in relation to possible extensions, and also the size of our footprint and the ability to be more efficient with, for example, our waste dump and other infrastructure locations. So we're excited about Beebyn-W11 and the opportunity we have to replicate the very strong execution success we've had at Iron Ridge, as well as the operational success and the consistency of those operations. So, Michael, yes, they're very similar. In terms of the broader Weld Range, Sino Steel Midwest have close to 300 million tonnes of JORC resources of hematite, high-grade mineable mineralisation. And they're not the only owner of tenement packages with known iron ore deposits in the region. We think we've demonstrated with Iron Ridge that we have a very efficient logistics pathway to monetize those resources. And so we're looking at how we can add inventories either through exploration, acquisition, or partnership. We know this material has been market tested. Mount Gibson, when they commissioned the project, sold just more than 300,000 tonnes. One of the things we've spent our time doing is looking at how we could mine that mineralisation differently. And as you've seen in our stage 1 decision to restart, we're confident that we can produce a product at around a 60% iron grade average between the lump and fines. And we're confident that that has strong market appeal on the back of the brand that we've established for our Iron Ridge material. It will obviously have a different price point to the high-grade Iron Ridge material, but the mine is also 200 kilometres closer to the port. And so, as you've seen in our projected C1 cash costs, there's a significant benefit in terms of costs to the project. And so we're really excited to get that back up and running. Very low capital and similar to Iron Ridge, very quick to return value to shareholders. As I mentioned in the intro, yes, we are currently achieving 4 million tonnes. More than half of that is for third-party customers, but it demonstrates that what we always believed was possible once we expanded our on-wharf storage capacities, that sort of throughput is possible. And we now know that we're capable of a lot more. Just to recap, Fenix controls Shed 13, which was the facilities we acquired from Sinosteel at the inception of production of Iron Ridge. That included the only side-tipping truck unloader and related conveyor infrastructure, and Shed 13, which has a storage capacity of around 80,000 tonnes. And then with the Mount Gibson acquisition, we added Shed 4 and Shed 5. So collectively, we've now got 440,000 tonnes of storage capacity across 3 very large, important pieces of infrastructure. And we own the connecting infrastructure to both our truck unloader and the Midwest Port Authority rail unloader. To answer the question around potential maximum throughput, we know that with only some of that infrastructure, Mount Gibson in their heyday did 8 million tonnes a year, predominantly out of Shed 5, so one of our facilities. With the $350 million government-funded PMAX program that the Midwest Port Authority instituting, and the fact that we have investing in updated and more modern infrastructure around those facilities, we're extremely confident that the facilities and the infrastructure we own at the port is capable of doing more than 10 million tonnes per annum, easily and efficiently. That's a very exciting concept. If you think about the Midwest, the billions of dollars that have been spent defining bulk commodity export potential from the region, all of which has been dedicated around Oakajee rail, Oakajee port development, we believe we can unlock that value with our existing infrastructure and the existing facilities at Geraldton Port. And so that's really exciting. Back to the more immediate future, clearly our existing infrastructure supports our immediate plans to be a 4 million tonne per annum miner. And that capacity allows us to grow our third-party business at the same time to perhaps similar levels without really stressing that infrastructure. Ruvidini is a really exciting development. You saw us spend, roughly $8 million of capital in the June quarter. Almost all of that represents the value of the Ruvidini investments we're making. And anyone out in the Mullewa district will have seen the improvements we're making to the road network. And if you're closer to Ruvidini, you'll see what is a very impressive radial stacker. The justification of that investment by Fenix is the $70 million logistics contract we've signed with Gold Valley, and it is a game changer for that operation, being able to improve the efficiency of their haulage from Wiluna by effectively cutting out the need for their driver rotation to get through the last crowded 100 kilometres between Ruvidini and Geraldton and then return. And it allows us to really efficiently move that material quicker and easier from Ruvidini into our sheds and then onto a boat for those third-party customers. And so that will support that contract. We're very eager to get that up and running. We're largely complete on our side of it. We're waiting for ARC to approve the rail crossing that will enable us to commence. And we're working with all of our partners on the risk assessment of that to get it going as soon as we can, because it will be a real game changer for Gold Valley and for Fenix and for all the road users in the Mullewa region and for Geraldton in that matter. It's a real increase in efficiency. Stepping out a bit to our broader business and what I've described about our capacity at the port, Ruvidini is a rail siding. It allows us to look at how and when we would transition material onto rail or augment our production tonnages as they increase with rail delivery into the port. But it's also a far more efficient way of gathering material. If you think about Iron Ridge, we have now demonstrated over a number of years that we haul very efficiently at 4,000 tonnes a day. And you've seen us doing 2 shipments a month, which is consistent with it taking 15 days at 4,000 tonnes a day to build a 60,000 tonne shipment. And so that means over a 15-day period, we're using that shed to store 1 boat. If we haul from the broader Midwest region to Ruvidini and then can bring in tonnes at 8, 10, 15,000 tonnes from Ruvidini to the port, it means that we could build a ship at the wharf in potentially 5 days, not 15, and that effectively triples the production capacity of that infrastructure. So that's just a very simplistic description of how important we see the Ruvidini rail siding for our future ambition. It is hugely efficient for our current operations, particularly our third-party users. It opens up a number of opportunities for us as we look at other operations as to how to make those operations logistically feasible. So, a slogan for Fenix is unlocking value in WA's Midwest. Ruvidini is a wonderful piece of infrastructure when added to our rail sidings, our new haul road logistics capacities, and our new haul port logistics capacities to the business we're building. So stay tuned for how and where we're going to use the value of what we're building there. Question. Obviously, when we look at the capital we've allocated to Shine, very low capital for a very quick return, $7.5 million. It relates to the $15 million of capital right back in 2019 we identified in the Iron Ridge project, which we then delivered on time and on budget, and the 25 total capital budget for Beebyn-W11. We can get these mines up and running very quickly for very strong return on investment. That obviously doesn't allocate any capital, the expansion, the significant expansion of our road haulage fleet. And that's because it's largely self-funded. And if you look at the original joint venture between Fenix and New Haul, when New Haul was privately owned and we were in a 50-50 joint venture, Fenix put in $1 million capital and New Haul put in $1 million capital to start that business. And then we lease financed all of the rolling stock, both the prime movers and the construction and delivery of the trailers. And we intend to do, and we are doing that as we expand that fleet significantly to cater for our increased production. It's high single figure asset-backed lease finance type facilities provided by very strong logistics financing partners, Volvo Finance and banks, who are very supportive of the business. And so it allows us to leverage the expansion without requiring capital from headco. The fundamental part of our business, we've spoken about the exciting capacities of the port and what Mount Gibson did in their heyday and what we think we might be able to do in future. One of the strongest enablers of that is our ability to retain a great crew of current drivers and then recruit new drivers into that business. I'm very proud, Craig Mitchell and his team are building a fabulous business and a fabulous team in both our New Haul road logistics business and our New Haul port logistics business. And compared to anyone in the industry, we have an incredibly low regrettable turnover. So we do a lot to retain our drivers, which is number one in an industry where people come in and out of the industry often. We do a lot of training and a lot of recruitment. So for Iron Ridge, we have a fleet of just under 30 prime movers and road trail combinations. And to support that, we have a fleet of around 70 drivers. With the addition of our third-party business and the restart of Shine and the commencement of W11, that fleet will in fact expand to around 70 road trains and trailer combinations. And so our pool of drivers will need to go from 70 to around 200. So if you're in the Geraldton region and you buy the local newspaper, you'll see that twice a week we have a whole back page ad asking for people who are interested for employment. Fenix created more than 200 jobs in the Midwest across our business, and we're certainly going to create a lot more than that over the next 6 to 12 months. And we've started that process both in terms of adding to our fleet and recruiting drivers 6 months ago. And so it's a very programmed and measured performance and a key part of our business. I've answered that in some meetings by saying we'll haul gum nuts if someone's willing to pay us for them, and if China's looking to buy them for $150 a tonne, you'll find us moving them. So the exciting thing about that map in our presentation, which has got more than 100 dots on it representing projects that are in feasibility study, they are bulk commodities that we've identified, and that's not just iron ore, it's manganese, spodumene, garnet, talc, silica sands. There are a number of other logistics opportunities, and I think the way to answer the question is to describe that we're building a business with 3 pillars. We're a mining business, so we look for opportunities, relatively simple, high-value opportunities where we can own and control the commodities that we mine, and Iron Ridge is a great example of that. Shine is another, and now Beebyn-W11. The second pillar of our business is logistics and our road haulage business. And the third pillar of our business is our port logistics business. And we're looking to expand those. And obviously, an example of how we're doing that is the Twin Peaks mine, where we've unlocked value on a third-party mining business. And then on a pure logistics business with the transactions and the services we're providing to Coofee and Gold Valley. The way I describe those 3 pillars is that our road logistics business really has 2 clients, either our Fenix mining business, as from inception, or our Fenix port business, where we're unlocking value in what is a really key critical constraint to most businesses, which is how do we get our product into a boat and into our customers' hands. So the real answer is anyone who is looking for significant port export capacity out of Geraldton, please come and talk to us. And the answer to that question is yes. If we've captured a port logistics customer, we think we are best placed to then do their haulage most efficiency and at the best value to them while driving strong returns to Fenix. And that goes for any material. We've got 3 completely separate on-wharf storage facilities at Geraldton. We have 40 hectares of land at the Nungaloo logistics hub just on the outskirts of Geraldton. We have rail sidings and now an inland port, and all of those can cater for any commodity that we would wish to work with. Look, started my career as an insolvency practitioning accountant. But so the first way to answer that question really directly is we're not looking for distressed assets. We're looking for strong partnerships. So if you look at from inception, whether it's Sinosteel with our offtake agreement and our shed purchase, or Mount Gibson, who are now the largest shareholder in Fenix, the Fenix Newhaul joint venture, now a wholly owned business, our relationship with the Wodji Yamaji, we're looking for strong partnerships where we can provide value to our shareholders, but where we add value to other people. And that's also the case with the Athena investment. So 10M was an opportunity for us to unlock value in a stranded deposit. There wasn't a dual resource. There wasn't a mining operation that we could see. And so risk on the mining side was really held by the owners of the deposit, being 10M. Fortunately for us, they produced a really good first shipment. Unfortunately for them, they then went into administration. We've supported the company and the administrator in what is a very positive outcome for all the stakeholders, being a deed of company arrangement which sees 10M survive. And the answer to the question around upside is it's all upside for Fenix. got a 50-50 profit share. We have a logistics customer. If they can produce ore, then we will again start shipping that ore and we'll make a good return both on the logistics and the profit share. If for whatever reason the company isn't able to produce, then we have the opportunity to acquire the project. But we're confident in the proponent and their ability to get mining back on track, and that'll be more throughput through our port and a good outcome in what we hope to be a positive partnership. Strong hedges in place out to December. Obviously, our hedging program is opportunistic. The need for that has changed. The way the Beebyn-W11 right to mine is structured is we have a payment for the use of our logistics function, which includes a return on the investment we've made in that infrastructure before what is a notional profit share between ourselves and Sinosteel. And that provides Fenix with a return that is somewhat independent to the iron ore price. Shine, we're looking at offtake opportunities which might be more a direct model of securing some level of support for the price line on that product. And then from Iron Ridge, you can expect us to continue to opportunistically look at those swaps, which have provided a strong support for the margin that we produce. The way I always answer the hedging question is to point out the best hedge for any miner is to bring your costs down, maintaining Fenix's C1 cash cost where we are is effectively a cost reduction when you look at the double-digit inflation that's occurring in the industry. The teams across our mining business, our logistics business and our port business are doing a great job. As we increase our volumes and as we bring on new projects, the benefit of scale has the opportunity to flow through in that cost line, and that will potentially provide greater strength in our margin, a more robust business to ride through the cycles of the iron ore price. And all of that will be taken into consideration as we look at the level of hedging and what sort of hedging we will do. But the answer to the question, where it makes sense to hedge, we will. But we're also looking to de-risk our projects through the style of the partnerships we enter into, and most importantly, building a long-term, high-scale, sustainable business. Fenix has been really transparent on our dividend policy. At inception, we were a highly opportunistic, single asset focused company. We have a dividend policy that said we were going to return 80% of net profit after tax to shareholders, subject to the availability of franking credits. We've altered that dividend policy to remove the percentage of NPAT and to describe that we will seek to pay a dividend based on our full year profitability with a view to not only franking credits, but also the capital investment required to fund a growth business. Investors should be comforted that the market's starting to respond to the growth potential of Fenix. You see that in share price and in the market capitalisation. We will make sure that we manage our balance sheet conservatively. We see further opportunities to fund growth, and it's important that we maintain the capacity where we can. If we have a fourth mine and a fifth mine in line, we want to be able to fund those developments and fund growth, as you're seeing at Ruvidini and Shine and Beebyn-W11. So the answer to that question is we are committed to the dividend policy as it currently reads. It's very straightforward. The board, once we've got the full year financial results, will sit down and look at the availability to pay a dividend based on our profitability and based on the capital requirements of the company. But I will say that we recognise the enthusiasm from shareholders for the company to be disciplined about returning value. It's something that isn't done consistently enough across the industry. Fenix remains a highly profitable company. And the other point I'd make to shareholders is that the board are all shareholders ourselves, significant holders of stock. And so we will seek to make the best decision to drive value for shareholders based on that policy. And if you're looking for a more definitive answer, then you'll have to wait till the board meets because we haven't yet made a decision. Similar to what I started, if you've come all the way through the half an hour webinar, then thank you very much for your obviously great interest in Fenix. It is a very exciting time. I'm looking forward to getting out to the Diggers and Dealers Conference. And we're really turning the corner for the next stage of development of Fenix. We're going from 1 mine to 3 in the next 6 months. We're building a great team across our Fenix mining business, our new haul logistics businesses. And stay tuned for more from Fenix. The Midwest is a fascinating and high value area, and we expect and are motivated to build a really big company.